Let's address the obvious right away. If you draw a standard salary and hope to bump up your basic exemption limit, you're out of luck. The tax math and the rate slabs you used last year apply to your paycheck exactly the same way right now. But while the rates sat still, the actual rulebook governing how those taxes are collected has been completely rewritten. Starting April 1st, 2026, the Income Tax Act 2025 replaces the 1961 Act in its entirety. This wipes out decades of legacy terminology. For instance, you will no longer file for an assessment year. We are finally just calling it a tax year. The paperwork is shifting too. If you regularly use Form 15G or 15H to manage TDS, you'll be asking your bank for Form 121 from now on. To get to this streamlined system, you and your CA are going to have to unlearn all the old section numbers you've memorized. You pay for long-term simplicity with short-term friction. This budget prioritizes a mechanical overhaul of the compliance system over any actual reduction in the individual tax burden. Let's look at the standard salaried filer who just wants to get their taxes done without a headache. The new act introduces a massive compliance safety net. If you realize you made a mistake on your return, you now have a standard 12-month window to file a revised version and correct the error without automatically triggering a default. The trade-off for this breathing room is time. Because you have a year to fix things legally, it takes a full year longer for your tax status to be considered completely finalized. But let's look at the alternative path on our chart. If you wait to fix the error until the government initiates a formal reassessment against you, the situation changes. You can still file an updated return at that late stage, and doing so will successfully halt prolonged litigation and potential criminal prosecution.
Warning tone. But buying your way out comes at a hard cost, a mandatory 10% penalty on top of the original tax you owed. For the standard filer, the government has traded rigid deadlines for a flexible system, where you essentially pay a premium to buy peace of mind if you slip up. High-frequency futures and options traders who thrive on market volatility are now facing a brand new set of baseline transaction costs. This table compares the old environment to the new one, and it highlights a major headwind, a steep hike in the securities transaction tax. When you look at the exact percentage jumps on the right side of the board, the increase is sharp. Your baseline cost to execute a single transaction is now noticeably higher before you even look at your profit margin. Because of that higher friction, your net ROI drops. You are now forced to hit a demonstrably higher win rate this year just to break even compared to your performance last year. And the friction doesn't stop with derivatives. We also need to look at the new rules surrounding corporate share buybacks. In the past, if a company bought back its shares, the proceeds were highly favorable, often tax-free for the retail investor holding the stock. Under the 2025 Act, those buyback proceeds are taxed directly in your hands as capital gains. This strips away the tax advantage entirely, forcing buybacks to carry the exact same tax burden as if you had simply sold your shares on the open market. The government is actively using the tax code to squeeze the margins out of speculative trading and close corporate loopholes, pushing heavily toward long-term investing. Let's look at the final profile, the global spender, the NRI, or the parent sending tuition money abroad. This group gets a major win on upfront cash lockups. The tax collected at source for foreign remittances has been heavily slashed. Previously, you were forced into a restrictive 5% or 20% upfront collection. That has now dropped to a flat 2%. This instantly improves your liquid cash flow when you book a foreign tour or wire money overseas. To be clear, your final tax liability at the end of the year remains exactly the same. The difference is simply that you no longer have that large volume of cash locked up with the tax department while waiting for a refund. And if you have older foreign accounts that slip through the cracks, there is a new Fast DS 2026 initiative. You can disclose those assets, pay a settlement fee, and secure immunity from prosecution under the Black Money Act. For global spenders, this shift removes a major liquidity hurdle. It ensures your travel or tuition budget stays in your bank account, rather than being siphoned off as an interest-free loan to the state. Let's bring all three of these profiles together on this scorecard to see exactly where everyone stands.
The salaried filer didn't get any extra cash, but they walk away with a neutral to positive impact thanks to the safety of the new 12-month revision buffer. The active trader faces a negative impact. The math works against them now, and the primary action item is reducing trade frequency to hunt for higher conviction setups that offset the STT bleed. The global spender lands safely in the positive column, walking away with the clear action item to utilize that extra 2% TCS liquidity. If you want to know exactly how to update your financial strategy, make sure you subscribe. In our next video, we are doing a complete translation, mapping the old 1961 Act sections directly into the new rules of the 2025 Act.